I'd like to welcome everyone to the Vermont Community Foundation's quarterly investment call. I'm Nancy Roden-Brock, VCF's VP for Finance. Dan's off today, but he sends his best regards to everyone. I'd like to take a moment to provide a baseline for today's presentation. The Vermont Community Foundation's approach to investing is aligned with our mission and the values and objectives of the foundation and our clients. We invest for the long run, aiming to ensure that the resources provided by our fund holders to support our community's needs are there now and into the future. We use a well-diversified asset allocation strategy and disciplined execution with highly capable investment managers and index funds. We are unusual, if not unique, in that we allocate 5% of our fund's assets to Vermont investments, and we published our first mission investment report about a week ago. If you haven't seen it, you can find it at our website. It provides insight on how these investments are creating opportunities for Vermonters, particularly those who are disadvantaged by place, race, or economic background. Finally, I'm delighted to have Lawrence Miller on board at VCF for the next few months. He's working with us to guide strategy and develop processes that will ensure that our Vermont mission investment portfolio will have an even greater impact over the next 5 years. Now I'll turn the program over to Mike Miller, Chief Investment Officer at Crucial Partners, VCF's investment advisor. Please put your questions for Mike in the chat, and we'll get to them at the end of the presentation. Thank you. Thanks, Mike. Take it away.
Thanks, Nancy, and good afternoon, everyone. So I've brought my slides up. Hopefully everybody can see this. We're good? Good. Thank you. Thanks. So again, it's really nice to be with you all today, and hope everyone had a very nice Thanksgiving weekend. And so a lot of things to talk about, obviously, the biggest one being, of course, that we are certainly living in a very complicated investment climate and a very complicated climate in general. But the thing that's always very interesting to me is the way in which complexity, which is quite unnerving for all of us and frustrating and a little sometimes really makes us a little sad, is actually really, really good for long-term investors. We've been taught this lesson many, many times before. And it's one of those interesting things, every time you learn it, you seem to forget it next time things go south again from a capital market perspective. So I'm going to walk you through today and spend a little more time than normal on the different ways we think about performance. Nancy pointed out a lot of really important components of the strategy a minute ago, but I think the most important thing of all the things that she said was the fact that we're very long-term, and we think about everything we do with that lens in place. It's extremely interesting from that perspective. So let's start with the returns. I'm going to give you an update actually through Friday because it's a lot better. So that's nice to be able to say. And also, but let's talk about what we have at the end of September. So you can see the long-term pool, which is the first line, was down 19.6% thus far in 2022. Through September. Its benchmark was slightly worse, down 19.9%. No one's doing a victory lap around a nearly 20% loss above the benchmark or not. As you go across the page, it's quite anemic, these returns. We wake up in the morning, I will tell you, thinking we need to earn 7, 8, 9% per year to be happy with the long-term outcome we're getting. But one of the things we'll talk about today quite a bit is the fact that endpoints can really distort the way you see things. I'm going to show you a couple examples of that in a minute. And you can also see the portfolio has slightly lagged its benchmark for 3 years and 5. That's the long-term pool custom benchmark underneath. That benchmark, just as a reminder, takes index funds and mimics the strategy. So we've outperformed a little bit so far this year, and we've outperformed by more meaningful margins over, as you can see, 10 years, 15 years, and since April 2002, which is when Crucial, and I actually personally got involved with the Vermont Community Foundation. So it's been a wonderful 20 plus years already, which is great. We also compare returns to the CPI plus 5%, because that's the other very important metric here, which is we want long-term returns that exceed inflation plus 5% of this pool. You can see we're not there. And you can also see very quickly why. You don't need me to tell you inflation has come roaring back here in the last year in particular. And when capital markets are down 20% and inflation's up, CPI plus 5 is up 10, it does a lot of damage to the long-term numbers. But again, I will show you a comparison in a second. I think we'll put that in some context. Underneath that is the socially responsible pool. which is down a little bit more than its benchmark. It's down 21.5% year to date versus down 19.7. A lot of what's happening there is that it's also outperformed for 10 years and matched its index for 15. But what's happening here is that socially responsible pools, which have various types of screening applied to them, tend to outperform in growthier markets and do a little less well in a market like we're in right now, which is more value oriented. A big reason for that, frankly, you can point to one fact and one fact alone that explains a lot of things in the markets today, which is, do you own fossil fuel companies? Without talking about the impact on our climate and our planet, the fact is you wanted to own fossil fuel companies over the last 12 months because prices have risen. I'm not suggesting you should own them, but that's been a very important driver of returns. And then for the markets, I should say. And the socially responsible pool has extremely low, if none, actually no exposure. The midterm pool is actually also down quite a bit this year, which is the other big news event of 2022, which is that there's really been no place to run, no place to hide. Stock market's down a lot. The bond market, if you look at its returns, is down a lot. So it's been actually, I don't know if you all have seen this statistic, but it's the worst performance for a blend of 60% stocks, 40% bonds since the Great Depression. That's what we're seeing in 2022 so far. So it's a very unusual year, and I think that's important. And it's not all bad news. Everything in life, I noticed, is we like to get more for less. I mean, most of us like a sale, especially get something a good bargain. We don't tend to treat our investment portfolios that way. We tend to think that we want the prices always to be higher, which is interesting because we own the assets, of course. But you should not forget that a bargain is still a bargain, and that's what we're starting to see is more and more bargains emerge, which is part of the message for today. So now this chart, this is the same exact page. Now, little sleight of hand. You'll see at the top, the date is different. This is the table we looked at a year ago. And I just pointed out just to show you, first of all, I mentioned 7, 8, 9% returns as our compound goals. And here you can see for the long-term pool and the socially responsible pool, that's exactly what's been generated over long periods of time when you were back a year ago. And you look at this, and we've sunk all the way below. So which is truth? The 20 years that ended in September 2021 or the 15 and 20 years that ended in September 2022? And the answer is neither. They're both just data points over time, and they move around. And the key point to make is what we have in the bullet points. One is investment outcomes are cyclical. There are always moments when things look really bad. Doesn't mean they actually are bad. And there's also moments when things look really good. Doesn't mean they're actually that good, which is why we're so focused on how are we making and losing money when it comes to the returns in this portfolio. And you'll see at the last bullet point, we've written something really important. There's a very big difference between a temporary loss, i.e. the market doesn't want to give us a good price for some today, and a permanent loss. I won't give any specific examples other than let's use a very prominent one that's as easy. So if you owned a lot of FTX, the crypto company, that's a permanent loss. You're never going to see that money again if you were a shareholder, I mean. And so that's the kind of, we don't have that loss, just to clear the portfolio. That's the kind of loss that is intolerable. Long-term investors are not bailed out when they own bad businesses, bankrupt businesses, or pay too much for things. But you are bailed out if you wait a little bit for just the markets to come to their senses. And that's a really important part of the equation today for everyone to remember, is that a lot of the pricing in the capital markets today is oddly nonsensical. I can't even tell you how excited we are about some of the bargains in this portfolio today. It's one of the most remarkable setups I think I've seen in my entire time working for the Vermont Community Foundation. Now, with that said, there are bargains for a reason, which is that we do live in a very complicated time. I will not go through the long list of things that we can all agree to be worried about. But with that said, it's also interesting to think about the fact that people get I feel like the psychology of investing is fascinating. And one of the things that people seem to think about, in addition to liking higher prices, not lower prices, they don't like bargains, they also we all suffer from a psychological trait, which is that we have something called recency bias. And actually, if you look at how most of us feel, the reason we feel badly in a bad market isn't because of the losses we've had alone. It's the losses we've had plus the fear that there's more to come and it's not going to get better anytime soon. That's what recency bias feels like. Is it just whatever's happening is going to keep happening? And that, by the way, that also fools us in bull markets where we think good times last forever and we think bad times also last forever. And obviously neither is true. Markets are extremely cyclical, and cyclicality and recency bias are not good bedfellows. So you have to be really thoughtful about the fact that we're being fooled all the time. And the other point, which I always find fascinating, is people seem to get more and more confident in the bad times. They know what's going to happen next. And the reality is that markets are never predictable, and they certainly don't become more predictable during a complicated time. And I think that's really another misnomer people have is, oh, I'm going to figure out what inflation is going to be or what the economy is going to do. And that's going to tell me what the market's going to do. It just doesn't work that way. I'm sorry. It's way too random. And the problem, which we've outlined in this table, this chart we have on the screen here, is that if you try to be clever and you say, well, I'm just going to step aside, wait for things to calm down, you frequently miss some of the very best days in the stock market. Stock market performance is not consistent. It's extremely aberrative. And you get these incredible periods of upswing that nobody sees coming and the downswings too. So what this table is looking at is from 1995 to November of 2022. If you just stayed in the market the entire time, you would have earned 8% per year. And look what happens, pull out the top 5 days. So nobody actually misses the top 5 days, but it only took 5 days out of, what is this? This is a 27-year period. 5 days, you almost lost 2% per year of your return over the whole 27 years. And if you miss the best 30 days, your return goes from 8% to 1.4% per year. So this is the reason that while it's not fun when you're sticking to your strategy, as Nancy described, and it's not working. But what is fun is waiting for things to work out and knowing that we're not going to make this mistake. I forgot to do something really important. I can't believe I did this. Let me go back. Let me give you the update through Friday. I forgot that part. I'm so excited about the future. Let's talk about the performance through Friday. So the long-term pool is actually now down 11.8% year to date, not 19.6% year to date. And the socially responsible pool is down about 13.7% year to date. So again, we're making inroads into these shortfalls, but we're not quite where we want to be. And I'm back to this chart. Do not take anything I'm saying as a prediction of what will happen next. We don't know. We would love to get maybe, I don't know, under a 10% loss for the year, but we don't know what's going to happen, just to be clear. It could be better, it could be worse. We just don't know. But the returns are much better than the ones we're showing you here, at least so far. So the other thing, which I mentioned recency bias, the other thing that people tend to think about a lot during bear markets is they start to get this sense of doom about long-term returns and short-term returns. And actually history teaches us we shouldn't actually feel that way either. So here what we did is we took the long-term pool alone, not the socially responsible, only because long-term pool has a longer track record. I'll show you some more about track records in a minute. But from April of 2002, again, where we started, long-term pool has had at least a 10% loss on 24 occasions. So we call that a drawdown or a peak to trough loss. So from the peak of every positive return, every time it was more than a 10% loss from that peak at any month end, we just counted them up basically. And there were 24 of those times. And if you look at what's underneath here, here are the returns following those losses. So take those 24 times, and then what happened next is the key. So that's really important. We're not erasing the losses, they're there. But if we're sitting at that moment of, we're down more than 10%, how do we feel a year later? What's interesting, if you look at the top line, we should feel really good, but we don't, which is that the next 12 months on average, the median is the average, the middle of the distribution, the portfolio was 19.5% higher than it was, at that point that we felt bad about the returns. The worst thing that happened to us is we had a 5.4% gain 12 months later. And the best thing that happened to us is we had a 41% gain in the pool 12 months later. Again, think about that for a second. Nobody thinks about it that way, right? No one's like, oh my goodness, good times are coming. But that's what history suggests happens. And that's back to market cyclicality, overreaction, the emotions that we all feel about markets are all part of this equation. Now look at the other numbers. Now these are per year. So 3 years forward, the median outcome was an 11.5% gain per year. 5 years forward, 11.6, and 10 years, a decade later, we'd earned almost 9% per year following these drawdowns. Now, I showed you some 5 and 6% returns before. So one of the reasons that I'm kind of blithely dismissing those and saying, don't worry about that, come back in a year, let's look again. And one year after that too, things tend to change. And in this case, we have good odds they'll change for the better. Nothing is perfect, of course. But the other thing which is interesting is take a look at for 5 years and 10 years, the worst case scenarios were a 9% gain per year for 5 years and a 7.2% gain for 10 years. And this ties back into what Nancy said before. We are, and I'm not referring to the committee or anyone at the foundation, but crucial, at least, we're a little greedy, which is we don't want to leave a single nickel of profit off the table. So we do everything we can to ensure this portfolio is sitting positioned for what's coming next. We can't change the past, but we can react in a way that's productive for the future. Now, the 9/30/21 date, just so you know, that the only reason we're saying that's the end point and not 22 is we don't have 12-month returns following this drawdown yet, so they're not in the data. That's the only reason we're suggesting that that's interesting there. So I'll keep moving. So I talked a little bit before about underperformance, and you might say, God, I would like you guys to outperform all the time. And by the way, so would I, just to be clear, I think so would everyone at the foundation. However, we think there's a trade-off here, which is the only way we could really do well all the time would be to stick very close to what's popular at any moment in time. So we get in trouble, quote unquote, I'm being a little sarcastic, when we decide to do something different than the market's doing. We do that all the time because we think popularity is our enemy. We think things that are overlooked are our friends. And so that kind of strategy really works over time. It doesn't work all the time. It takes time for it to play out. So what you can see here is we've taken the returns from the beginning and we've compounded them. Because one of the things I think it's really important to walk away from today is when you underperform for 3 years, that's disappointing. But if you underperform for 10, 15, or 20 years, that's a disaster. And you can see what we would have given up. So 3 years, it's not really multiplied, but you basically multiply the numbers on the earlier screen by 3. It's a compounding exercise, a little different. You can see we've earned a paltry, crappy 5.8% cumulatively. Our benchmark did 7.4, so we could have done better. Same thing for 5 years. But now take a look at 10 years. The compound or cumulative return was 72.4%, which is, it's not amazing, but it's nicely above that benchmark. But keep in mind that includes the shortfalls that we've had more recently. 15 years, we've earned 102% return versus 72.5% for our benchmark. And then since 2002, we've earned 256.7% return. Our benchmark's at 182.7. And this is that trade-off I'm referring to, which is we are not willing to not earn 256 versus 182 for our benchmark on a go-forward basis, just so that we can look okay all the time. And I'm sorry, you have to make a choice. You cannot have it all. You can't crush your benchmark and always beat it at the same time. It doesn't work that way. That's not the way things are. So we have to be realistic about what we're doing. And this is the way we think about this and why we're not dismissive. don't want to be too blithe about this, but we do not think the short-term returns versus the benchmark are nearly as important as the long-term ones. And I think that's the critical message to leave you with. So here, sorry, my screen's got a little stuff going on here. Sorry, I got a wall out there. So this is the other thing I want to emphasize to you, which is the way we think about performance is a little confusing, but I think it's really important. We don't think it's valid to say it's September 30th, 2022. Here are the numbers. They're etched in stone. This tells us everything we need to know about performance of the portfolio. We disagree with that because there's lots of different time periods along the way. And we looked at September 2021, as I showed you before, the numbers were very different. September 2023, they'll be different again. So what we've done here is we've done a different kind of analysis. And by the way, this is the right way to look at performance. It's not the easiest way to do it, which is why people don't do it, but it's the right way. So what we've done is we said, let's look at every single 3, 5, 7, and 10-year period. I think there we go. I'm missing something there. From 2010, which is when the social responsible entered its kind of modern era, through September of 2022. The batting average is the number of times, the percentage of the time the portfolio outperformed its market benchmark net of investment management fees. And we're very pleased about the fact that for the most part, these are 80, 90% or so success rates, which means if you think about it, if you came to, let's put it simply, if you came to 10 of these calls, on 8 of those calls, or 8 to 9 of those calls, you'd see outperformance over 5, 7, and 10-year periods. 7 out of 10 times, you'd see outperformance over 3 years. Now, let me give you a sense. We've looked at this for other portfolios that we don't advise, that the hit rates tend to be 45 to 50%. So that's the normal thing. That's the coin toss answer. This is not a coin toss. You can see this is actually a very dominant level of outperformance that happens the vast majority of the time, which is very important. Then you can also see, you always have and should have a conversation about when the index be better. And you can see here that the index in this case would not be better. And then the second question related to that would be, are you getting paid enough to do something different than the index? And so that's the second line, which is the median outcome, how much was it? And this is cumulative, not per year, above the benchmark. And you can see for 5, 7, and 10 years, 3 to 6% cumulative return above the index, again, net of the fees is very important, is a good outcome, and we'll take it in terms of being a solid outperformance. You'll see in a minute, the long-term pool's got different stats. This pool has more indexing in it going on, which is something that's a constant topic of conversation about what the right balance is. And the last thing I'll point out about this is look at the difference between the best and the worst case outcomes. With the exception of 3 years where the best outcome wasn't as good as the worst outcome in terms of the return relative to the benchmark, you can see that portfolio that has good times, let's look at 10 years, for example, it's about 9.6% is the best outcome above the benchmark. And when it didn't do so well, it was 4.8% behind the benchmark. And that skew is really important. So we need to have a high batting average, and we need our good days to be better than our bad days. And that's what this says is happening. And we need to outperform by a meaningful margin compared to the benchmark. So here are the long-term pools, same stats. This goes back further to 2002, because that's when we had this portfolio. And what you can see, which is also very interesting here, is that first of all, the stats are a little bit better. That's because we actually have had more tools at our disposal. This gap is closed over the years, as you can see. But the median outcomes now you can see are even bigger. That's because the long-term pool uses more active management. And if the socially responsible pool was able to effectively use more active management, we think we could expand those numbers too, which is what we're focused on right now. You can also see the best and the worst case outcomes are quite appealing here, with the last thing being, at least so far, and I hate perfection because perfection can never last, but our rolling 10-year returns from 2002 to 2022, actually these portfolios outperformed every single 10-year period since 2022, which is why the worst outcome was still 6% above the benchmark. So this is really important, because this is, again, how, if I'm sitting in your shoes, I ask myself the question, is there any consistency to this? Because I said earlier to you guys that, hey, over 1 year and 3 year periods, we're not always going to outperform because we're not willing to trade off lower 10-year returns in exchange for that. But what we do want to say to you, which is what this says, is yeah, but most of the time, you're going to look at solid outperformance over 5, 7, and 10-year periods in particular. And even 3 years, you're looking at a negative 3 and 5 year periods right now. But that's unusual, and we'll get it back, is my point. So I'll leave you with that thought, basically, and I'm not too worried about that. So one more thing on performance that I think is really important to talk about is the other thing, which I think a lot of people, rightfully so, will say about a strategy like this one is, it's kind of complicated. You've got all these asset classes, you've got all these managers, you've got some index funds, why bother is a question. And the answer is diversification. When you have hundreds of millions of dollars to invest, you can diversify in ways that smaller investors just can't do. And frankly, from our perspective, it's a shame not to capitalize on diversification. Diversification is the only free lunch in investing. So the more we can distribute these assets in prudent, appropriate, well-weighted ways, the better and the smoother our return streams can be while not sacrificing returns. That's always the tricky question, which is, how do I build a portfolio that produces what it needs to produce and does so in a way that is sensitive to both the long-term question of I need to compound capital at high rates of return, and the shorter to intermediate term question, which is these are funds that are here for right now, serving your community, and there's going to be spending from them. There should be spending for them, and they need to be there for everything that comes down the pike. And so these are really important things to think about. So what we did is to try to show you in a really, hopefully a very sensible way, why this works. We put together a simulation, and some of you have been on these calls before, have seen this, but this is the updated version. So first thing, we just created a hypothetical $1 million fund that showed up on March 31st of 2002. It distributed 5% per year. From that point forward, there were no new contributions made to it. So it was just that first million. Then what we did is we said, okay, let's invest it in one of 3 portfolios. The blue bars are the long-term pool we've been talking about. The orange bar is a simple 60% global stock, 40% US bond strategy. And then the gray bars just put it all in stocks, in global stocks in this case. So the very first set of columns is what was the ending balance of that fund with the market returns and all the spending over time. And you can see basically, because of this terrible endpoint, it's about $250,000, $300,000 above the original gift value is what the blue bar suggests, which is well above the 60-40 and slightly above the all stock portfolio. But now look at the middle set of bars, which is, let's just take all the spending that happened, the 5% per year over time, let's just add it all up. And you can see, actually, even though the market value is higher, which is the left set of bars, we spent more. And I'm going to talk about how that can be in a minute. From basically the portfolio that was invested, or the fund that was invested in the long-term pool. The total philanthropic impact on the right, that's just the addition of the first and the second column, which just gives you a little bit of a sense of how these two have interacted with one another. And there you can see a pretty impressive gap between the long-term pool and the other 2 options that we've shown you here. And so the key point, though, is that this is it. This is just we control risk through diversification in order to end up with this outcome. More money left in your fund, more spending along the way, i.e. greater impact. But that's not the whole story. There's another part of this story, which is here. So this is those middle bars, but let's blow them up. Let's show you over time what happened to the different spending rates that went on. And so what you can see is, so the blue line is the long-term pool, again, the year-to-year spending that occurred from 2002 to 2022. The orange bar is at 60-40 again, and the blue bar, and the gray bar, excuse me, is the global stock index portfolio. So the first thing is quite obvious, is take a look at how, while the long-term pool had one downturn, which followed the great financial crisis, for the most part, that line has headed steadily higher over time. It's pretty smooth, which is really important. You can't say that about the gray bar, which has, a much bigger dip than the Vermont long-term pool does, in the 08 period, or the orange bar, which just is much, much lower in general, the orange line, Now we've drawn these other two lines, which I think are really important here, which is that, as you all know, philanthropic impact doesn't just come and go because we feel like having it around. It's there all the time. We need to have the reasons that you guys want to distribute your funds, and that's really important. And the worst thing that can happen is a long-term period of subpar spending from your funds if you spend on the 5% rule. So the blue line, you can see, is again that very nice, steadily progressing piece. Its worst case scenario, you can see it went from 08 to about 2013, where it dipped and then it recovered. So it took about 4 or 5 years to come back from the great financial crisis. But look at the all stock line. It took from the same period of time, 2008, all the way till late 2020 to recover to the prior level of spending. And this is again why an aggressive all stock portfolio is not a good idea for anybody who's granting out dollars, in the here and now, and then next year and the year after and the year after that too. So this is extremely important. This is why we'd like to see the line going up, of course, but we also like to make sure that when it does dip, it doesn't dip too far and it comes back as quickly as possible, which is why I showed you some of that data earlier regarding the portfolio's positioning and the future returns when it does have downdraft. So let me just walk you through briefly the strategy we use. This will be very quick. It's very simple, by the way. I will say one of the problems that I have with financial people is they like to pretend they're brilliant. And I'll tell you right now, I won't speak for anyone but Crucial and me. We are not brilliant. We do very simple things and we just remember the rules. That's pretty much our strategy. So one, we think long-term. We're worried about preserving purchasing power over long periods of time. Right now, we're not doing it because inflation's been so high and the markets are down, but we did it a year ago over long periods of time, and we'll do it in the future too. I'm quite sure this is a wonderful time for that. Second thing is we don't kid ourselves. We don't think we know what markets will do next. We observe markets. We spend a lot of time thinking about them, but mostly to see where are people losing their heads and not thinking it correctly. And that's where we step in. So no market timing or changing strategy. We will be opportunistic, and that this is a time for that, by the way, today. And then last but not least, diversification. I've covered that several different ways, but that is incredibly important, fundamental bedrock principle of good investing. And I'm always stunned to see how people really don't seem to understand diversification because people get upset with parts of their portfolio that are struggling. But that's actually what diversification tells you should happen. If everything's doing well at the same time, you might not be as diversified as you should be. If everything's doing badly at the same time, you might not be as diversified as you should be. We should have things that are working at the same time others are not. It's an incredibly important concept, but people really get kind of worked up about the bad part and they get a little too confident about the good part, and we don't like that. So as Nancy said, here are the various mixes of the pools. The committee discusses this fairly frequently, but once a year is a really formal review that we do. And it'll be actually, we're talking about the mixes today a little bit later on in the committee meets. We'll also be doing our big formal review at the first meeting of 2023. So I look forward to sharing that with you at the time. But what you can see here is, first of all, the socially responsible and the long-term pool are very long-term oriented. They have 61 to 64% in public equities. Special opportunities, as a reminder, are these more idiosyncratic global equity strategies that we use in the long-term pool. And they've been they're very interesting. They're very different than the indexes, which means they can perform very differently from the indexes, both good and bad. And it's part of the strategy and part of the diversification benefit we have. You can see that we have relatively low amounts of money in fixed income, and that's because yields have been as low as they've been. Now, fast forward to our next couple of meetings, the yields are higher today. That's why the bond market's done as badly as it's done this year. But the reward for having these crappy returns this year is we now have higher interest rates, and we'll see what happens next, of course. By the way, forecasts for interest rates fall in the same category as forecasts for the stock market. If you know something about what will happen next, please tell me, because I don't. We just know that things will be what they will be. And then the last point on the bottom, you can see that the long-term pool has some money in hedge funds and private assets and private equity, which has been a nice contributor to returns over time. The socially responsible pool also has private assets, and that's also been quite successful so far, but it's a relatively newer part of the portfolio. The last 2 points I want to make on this quickly. One is that the long-term pool and the socially responsible pool have about the same risk profiles when it comes to the volatility of the assets. So that's very important. So yes, the long-term pool is doing a little better than the socially responsible pool this year, but both of them have similar risk profiles. It's more just the deviations of what's in private versus public and a variety of other factors that have led to the outcomes that you've seen. The midterm pool is a very balanced pool, as you can see, about 47.5% in public stocks, 47.5% in bonds. And of course, all of the pools add up to 95 until you put in the Vermont investments that Nancy mentioned earlier, because all of them have a 5% exposure there, which is, by the way, not only is it a really great part of the portfolio, it's actually also a part of the portfolio that further diversifies the assets, by the way, which has been a wonderful trait of that pool for the last 20 plus years that it's been in these portfolios. So quickly on a couple of things, and I want to turn to the markets and then get to your questions. I want to make sure we have plenty of time for those. So if you were an analyst at Crucial, so our team has 24 people on the investment team, 17 of whom are involved with in original direct research of managers that we put in client portfolios to recommend to our clients, like in the case of Vermont Community Foundations. So I'm CIO, so I get to oversee all that and also participate in it. And we teach the analysts 4 basic rules, and we teach ourselves, actually, I should say. One is returns are always accompanied by risk. There is no such thing as a return that does not include risk. And what you have to do is you have to think about, do I understand the risk? Because if you don't, you're in trouble. And 2, can I live with the risk if it comes to pass? And that's the 2 questions you have to always ask yourself. So when you try to avoid risk, you make big mistakes, you get fooled. When you just try to understand risk and build a diversified portfolio of different risks, you get a very different outcome, which is why we need to understand the strategy, know the key personnel, and avoid needless complexity. COVID really put a dent in our ability to do our jobs as well as we'd like to, because we couldn't travel for a while, but we're back out on the road, including globally. In fact, I managed to catch COVID in Europe about a month ago. I'm okay now, but nevertheless, but seeing all our managers and making sure we're finding the best managers in the world is a really important part of the equation for us. A place we don't take risk is operations. So in addition to Nancy and her team, which are very extremely strong in making sure that everything's accounted for correctly and properly documented, we also have an operational due diligence team at Crucial that checks on the managers both initially when we first recommend them to our clients and then on an ongoing basis to make sure they have proper auditor, administrator, pricing policies, cash controls. There's a long list of things that institutional investors do and always must check into. We refuse to have problems there. We will make investment mistakes. We will not make operational mistakes. That's just never going to happen for us. And last but not least, ongoing forward-looking process. That's the other point that I really think is worth emphasizing here. If you want to use active management in your portfolio, you face 2 challenges. The first is finding really good investment managers. Hard to do. I will be the first to admit we spend a lot of time and energy on it. So I can tell you it's not easy, but it can be done. But the second problem, which is even more nefarious than the first one, is most people react to returns in a backward-looking way. That's been the theme of today, if you didn't notice. So when a manager underperforms, we're like, oh, they're no good. Let's get rid of them. I want to do really well. We think they're really great. And that's problematic because if it's cyclical, and it is, then when we're reacting to bad returns, we might miss out on the coming good returns, and we get too comfortable and confident in somebody with good returns, we're going to be very disappointed with the bad returns that typically follow. So that cyclicality of performance is the Achilles heel of most actively managed portfolios. And the success of this portfolio over long periods of time is a testament to the fact that that is not what happens. I'll give you a quick example. We had a manager in the portfolio that was in our special opportunities bucket named Afissimo Capital. They were a Singapore-based Japanese activist, very concentrated strategy, had fairly good returns for a while, then had a really, really tough year in 2019 and 2020. And what a lot of people do when they see those numbers is they want to get out. And the reality was the committee and Crucial and Dan and everyone involved with the foundation did not. We were patient, and we were, by the way, we did our work and made sure these people were still good at what they did. And then they were up over 100% the next year, and then also did well this year. But we did not like the volatility. It was too much, more than we thought we'd get. So we have actually now exited, but we exited with a really nice long-term return. That's not the outcome it would have had if we'd done so when they first started to struggle. And so really important that you be patient and forward-looking. I'll skip this. This is amongst the many, many things the team looks at, and this is not comprehensive, believe it or not. So I'll keep going though. And I just want to spend a minute or two on the market climate. Because it is a complicated one and we do think about it, and it's part of the problem that exists out there for a lot of people. So I will say all of our optimism for this portfolio is not a universal thought for the markets. We worry about the markets, not short term, because we don't know. We think there's a long-term problem that's emerged for the markets, and I don't think people quite get it. But let's see. So first point, inflation is higher. And one of the reasons that's important is it's led to a change in the way interest rates are set by our central bank, the Federal Reserve, and other central banks around the world. And as interest rates have risen, it's done something which is quite logical, which is basically, we call that increasing the cost of capital, which means that investors demand more for their capital. In other words, more return for the risks they're taking. That's why you see a lot of speculative companies dropping in price quite a bit. That's why you're losing money in your bond portfolio right now. That's why you're losing money in a lot of different places, because people are demanding higher returns. And that's not the way people think of it. They think, oh my God, I'm losing money. Yes, you're losing money in the short term. If you don't sell, you haven't lost anything. Let's be clear about that. But two, you're basically going to benefit from a higher cost of capital. And that's good because you're the one providing the capital. However, the higher cost of capital story has not really fully translated into some of the things like the S&P 500 or even worse, growth indices. So growth indices are down about 25% year to date. And I hate to say it, but they're still probably, by our way of thinking about it, 30 to 50% overvalued. And that's the reason when you buy a popular thing, it takes a long way to get to fair value. That's why value investing actually really works, because we pay very little for things. And then we know we're okay. And if they drop, they just got a lot cheaper. But if you own something that was already expensive, dropping doesn't make it cheap. It might make it cheap, but it doesn't have to. And here's the last thing. If you come away from anything on this call today, other than thinking the Vermont Community Foundation really knows how to invest my capital and my philanthropic capital, I'd like you to walk away with that thought. The second thought I'd like you to walk away with, just personally, is don't forget that every single major downturn we have seen in history was followed by a new set of leaders. So a lot of people today are like, okay, when can I go back into those speculative tech companies? When can I do this? When can I do that? And what they're doing is saying, when can I go back to the stuff that worked for the last, sometimes 3 to 5 years, sometimes 10 years. And that this might be the time. That's not what I'm about to say is not true, but more often than not, the new winners are different. So as you think about your portfolio today, personally, think about, well, what don't I own that hasn't done so well the last 10 years? Maybe that'll be the thing that does really well in the future. Like maybe it's Japanese stocks, maybe it's European companies, maybe it's banks, maybe it's whatever it is that suits your fancy. But you should start, your first question to yourself should be, do I own stuff that has not been popular for a while? Because that's probably where the next set of winners is going to emerge. So please hold on to that thought as long as you can, because I think you'll be well served 3 to 5 years from now to have thought about that today. Okay. So I just made some comments about the S&P 500 still being expensive. It is still expensive. I'm sorry to tell you guys, those of you who are waiting for it to become cheap. But this chart is meant to tell you something different, which is that over really long periods of time, it's always fine to be an equity investor, and specifically in the S&P 500. And so this is essentially, as you can see, from 1928 to 2022, and it's got almost all of these are very negative events that occurred. You can have your own set of opinions on some of them, I think, but most of them are pretty clearly negative events. And what you can see is that a couple of things. One is, hey, this is the everything is fine line, which will be fine. It goes up over time. So that's good news. There's 2 pieces of bad news on this chart too, though. If you look very carefully, there are long periods of time where the S&P 500 doesn't go anywhere. Look at the left side of the chart. That's obviously the 1920s, the Roaring 20s, and the Great Depression. Look in the time of the Vietnam War in the 60s, the S&P didn't go very much, didn't do much. Look in the early 2000s, didn't do very much for very long periods of time. So this idea that we're entitled to some 7 or 8% return from the S&P 500 is false. That's not the way it works. And even worse is, because we're all victims of recency bias again, look at the right side of the graph. It does a wonderful job just going almost straight up. And there's plenty of stuff there from Brexit to COVID, or you name it, Russia, Shanghai lockdowns, et cetera, et cetera, et cetera, that are really, pretty negative events. And the market dips. You barely even see those drops. And they felt pretty bad at the time, if you remember. But the really scary part isn't that the market came back. It's that it did come back this way. Look at the rest of the graph. There are very few times in history that look like this. And I'm sorry, the world has not changed that much, where stock market just goes up and up and up and up and up and up and up, and it always bounces back very quickly from every decline. That's not the way it works. And so this graph and this right side, what we're seeing here is a trap. It's taught us all to think about, oh, it's going to come back quickly. It doesn't always work that way. And again, back to my earlier comment, even when it does come back, sometimes it's something different than what worked last time. So you have to really think about that, and don't be fooled by the fact that there are some very significant headwinds facing some of these stocks, and not all of these stocks, but the S&P 500 specifically. So here's one of them, which is that indexes like the S&P are what we call capitalization weighted. And what that means in English is the biggest companies have a bigger weight in the index. And by big, I mean number of shares times the current price. So Apple is the biggest company in the S&P 500 today. And last time I looked, it was about 7% of the index, give or take. And what this chart is showing is we add up the top 5 names: Apple, Amazon, Microsoft, sometimes Tesla's in that group, and others like that. I'm getting somebody, I'm sure. Those names are essentially 20.5% of the index after the decline we've just had. And if you take back all the way back to 1990, you can see how unusual this is for the index to be this concentrated. So the bad news is the index has a lot of money in some very popular stocks that have risen a lot in value and are still very expensive today for the most part. The good news is that there are 495 other stocks that have gotten a lower weight in the index. And that's where the opportunity exists, which is that there's a lot of things that have not been dragged into this crazy town valuation metric rubric that we have for some of these S&P companies. Lots of stuff to invest in the US that looks extremely interesting on a risk reward basis going forward. It's just not the index itself, because there's so much in these big names that have been successful. And if you went back about 2 years ago, I'm going to resuscitate this for another call. We looked at what happened to the stocks that led the S&P in 1999. And if you remember, those were names like ExxonMobil, Cisco Systems, General Electric. We could all probably agree, with the exception of one name, which was Microsoft, you didn't want to own those names for the next 20 years, and you didn't for the prior. And I think this is very important to remember: cyclicality. Amazon might be an incredibly dominant business today. It doesn't mean it will always be, and it doesn't mean the stock price isn't too high to justify whatever it can do. So one more quick point, and then we'll move on. This is the other thing that's unusual out there right now, is this boom in value in growth stocks, which is again Microsoft and Apple and Amazon. And this chart is looking at essentially how much, when the blue bar is above zero, how much the growth index has outperformed the value index. And you can see 2022 is highlighted because it's the first year of any significance that value stocks have outperformed, all the way back to 2006. There was one other year, 2016. So again, if you're a believer in cycles, and please be a believer in cycles because you should, this is interesting. We have had a heck of a growth cycle, and there's this sense people have like, oh, look at the growth stocks, they work. Well, they work until they don't. And you can also see that if you look back at the 2001 experience, value stocks started to do better in 2000, 2001, and then actually proceeded to do better most of the time for the next few years until we got to the great financial crisis. So it's just interesting to think about cyclicality, which is what this shows you. And then last but not least on this point, I'll move quickly. This is a look at valuation. So valuation is, what am I being asked to pay for something? So very quickly, PE is price to earnings ratio. And so essentially think about it this way: if the PE is 20 of something you own, if that something earns $1, you basically are paying $20 for the dollar. And growth investors are willing to pay more for things because they're growing more quickly. But the point here is that you shouldn't pay an unlimited amount for something just because it's growing quickly. You should pay a reasonable price depending on the growth. And this chart is showing you that for the most part, if you look at the middle line, the average from 1997 on, the growth index trades at about 1.45 times the value. So in other words, let's say, back to my 20 for a second, if I paid $20 for a dollar of earnings in the value index, I pay $29 for that dollar of earnings in the growth index. And that's perfectly sound because the growth stuff's growing quicker. You can pay more. What you can see here, though, is at the peak, it got to almost 2 times. So my $20 PE ratio for value was about a $40 PE ratio for growth. And you can see that even with the downturn this year, it's nowhere near the long-term average. And it's also many times in history lived at the very low end of this range. So that's a long way down from here. And I want to leave you with one more quick analogy very quickly, which is that a lot of people basically start an investment conversation by saying, I'm going to buy this company because it's great. It's going to grow, it's going to do this, it's going to do that. All good. And they forget to ask the second question, which is, what am I being asked to pay for it? And the bad news for people who leave out that second part is it's kind of like walking around in your entire life with only one shoe on. So if you're in a nice spring day, walking through a sunny park, the fact that one of your feet has no shoe on it is not a problem. But the minute winter comes through, the minute you get to a gravelly, rocky road, the lack of a shoe is a huge problem. And that's what's happening to people right now is they're only wearing one shoe. And so they're not understanding why the market's acting the way it is. And the market is basically rationally repricing very expensive, overvalued things. That's what it always does eventually. It just doesn't do it every time we think it will. And so this whole concept is so important. You need to wear two shoes to walk around this planet, which means you need to think about price, what you're paying for something, and the quality of what you're buying. They both go hand in hand. The reason, by the way, people don't think much about what they're paying for things is that's a hard thing to do. And if you say, I don't have any idea how to do that, that's totally cool. Put your money in an index fund, put your money in some good active manager you can find who actually gets paid to do those things with their active managers. So last but not least, I just want to give you one more piece of advice on timing. So if you're sitting saying, is this a good time to invest more money in my investments at the pool, in the Vermont Community Foundation? It's three pieces of advice. One, no one can answer that question. There's no way to know. We could be sitting here a year from now with another negative return. I had all that great data before that suggested that the portfolio generally does well after falling returns. That's not a law of physics, though. This could be the exception. You never know. But by the way, for the Vermont Community Foundation portfolio, if this is the exception, look at the last bullet point. We're already in the green zone when it comes to future returns. And I say that because we think about the quality of what we own and what we're paying for it. And right now, the markets are giving us companies for very low prices. We'll do this all day. Now, could those prices go lower? Of course they could. And if that happens, then the returns just got better, not worse. And I think it's really important to kind of think about that time horizon, how we're going to feel differently. But I want to also leave with the middle part, is that you need to think about your investments and the risk you're taking. And for most of you as donors, the risk you're taking is that you're going to want to grant out your dollars more quickly. And if you want to do that, you should have less investment risk because volatility and higher spending rates are a very bad combination. That graph I showed you earlier, where the long-term pool did so much better than the indexes, especially the global equity index, that's always true, but it's not quite as compelling if you're taking out 10 or 15% per year or 20% of your fund per year for grants and not 5%. So think about the mismatch. You don't want one. And the shorter your philanthropic time horizon, the more defensive your portfolio should be. And don't be cute. Don't try to say, well, this might be a really good time to be aggressive with short-term money. That's very risky, and I would not advise it. Let's put it that way. And then last but not least, here's our strategy looking forward. We're going to do what Nancy said at the very beginning. We're going to be very disciplined. We're going to stick to things that we can get right. Patience, really good due diligence, really good underwriting of what we're paying for things. This is what we do, and diversification. The second point, we have scale, hundreds of millions of dollars to invest. We have a really good long time horizon and investment committee and management team at the foundation that are committed to long-term outcomes. And so that's always really, really important, especially at times like this. And then the last bullet point is also important. Despite how uncomfortable it feels right now to look at your value of your portfolios, the value of your funds, the Vermont Community Foundation, don't forget that this is the kind of stuff that always has led to great returns in the future. In the prior periods like this were the precursor to really strong future returns. This time will be no different. And the only question we can't answer is when will things get better? We don't know that, but we know that if we own very inexpensive, good investments, time is on our side. So I'm going to stop there and see if there are any questions that I can answer for everybody. And thank you for your patience. I hope that wasn't too long-winded.
You did it, Mike. When I saw that deck, I thought, how in the world we're going to get through this in the time allotted? But thank you.
I had the same worry, by the way, Nancy. I was like, what slides can I take out though? I want them all in here. So sorry about that, guys.
Questions, anybody?
I see some in the chat. Should I just go to those, Nancy?
Absolutely.
Is that okay?
Yep.
Okay, the first one is, how has the allocation to managers or asset classes changed this year? Additionally, you mentioned being excited by opportunities going forward. What investments are you most excited about? Okay, good questions. So our allocations to managers and asset classes have not changed much this year, which means that we've been actively using cash flows to rebalance. So in other words, we started the year with a portfolio that had certain percentages with our different managers and in various asset classes like stocks and bonds, et cetera. And all we've done is, as we've had cash flows, we've used those like in or out of the pool. We've used those, which I will do. Thanks guys. We've used those cash flows to keep ourselves, kind of bring ourselves back to where we started. And that's because if we thought we had a good investment portfolio at the beginning of the year, the market drove it away from where we were. We wanted it back there. In fact, maybe even a little bit more tilted towards where it was in the beginning here. So we've been very careful to try to stay to the same strategy, not let the market change our risk tolerance, our risk profile. Then the second question, so that's also about in the manager level too. So our managers have underperformed. We've, when possible, tried to add money to those managers because we believe in what they're doing, and we believe that their portfolios got even more interesting because prices are lower. And just so no one's too worried, that's not an automatic thing. This is what that team I was talking about spends all this time doing, talking to these managers. And in a year like this, by the way, looking them in the eye, making sure that, one, we still believe that they're good. Two, that they haven't lost faith because they're also human beings and they're going to react the same way all of us do to bad returns and get nervous and worried and have anxiety about it. So we have to make sure that they're keeping steady hands at the tiller. So those are very important parts of the, make sure that's true and then add money if it is still true. And the thing is, what investments are you most excited about? I don't even know where to start, but I'll give you a few examples. Perhaps the easiest is, and you probably think I'm crazy, but the easiest is basically anything cyclical in Japan or Europe today, or value oriented. Portfolios in those parts of the world are basically being given to us at below book value, i.e. the value below book value is something you don't see in investing that often. Two, a lot of these investments are carrying 5% and 6% dividend yields. I mean, diversified portfolios of them. Three, they're trading at price earnings ratios of 7 or 8 times earnings. Just to give you the contrast, the S&P 500's, other things, at least Apple's price earnings ratio is over 20. So we can get companies that are not as good as Apple, but we get them for 70% cheaper. So I'll do that all day. And we know that if we just have things that are sitting there at these extremely low valuations, and they're not bad companies, they're not businesses not things going out of business, we'll be just fine. In fact, just sitting on the dividends gives us 5 or 6% per year, and the rest will take care of itself. There's also a lot of that kind of thing happening in growth stocks in the small and mid cap area right now, because there's been, and I hope you don't own too many of these, but there have been 80 and 90% declines in price. And that's because markets are doing something they always do, which is oversimplifying. Interest rates are higher, the cost of capital is higher, as I said earlier. Every business that's got growth and earnings down the road is now persona non gratis. Some of those businesses should be out of business, some of them shouldn't. And the ones that have been really, quote unquote, crushed, but they're good businesses still, we're seeing a lot of that in some of the growthier parts of the portfolio. Okay, I do not understand what you meant by the amount of annual giving and long-term market growth versus short-term growth. So what I meant is that basically, when we're taking money out of the portfolio every year, we want to make sure that the volatility isn't too high, because we don't want to be forced to sell lots of what are already very inexpensive assets to fund the spending policy. That's what I'm basically saying. So when you dampen that volatility a little bit through diversification, what you do is you leave yourself less exposed to the risk that you're selling at a bad time and when you take money out. So that's the difference in the long term and the short term, basically. Next question, if you don't mind. Good point, Reed. Tilting to defensive strategy if fund payouts are high. Where to hide in such markets, private asset strategy. So good question. So nowhere to hide in these markets. That's the challenge. So don't hide. Basically, do what I said earlier. Go find the stuff that's down a lot that people really hate. And I hate to say this to you guys, other people think this is a little crazy, but the more complicated the story is, better sometimes. People don't like complexity. We already have enough complexity in our lives. So stocks with complexity can be a real problem. I can't give an example because there's not enough time, because a lot of those stocks in the portfolio where they've got competitors, their balance sheets may not always be the greatest, but there's ways for them to solve that. And that's where we've made most money more recently in particular. Private assets, just really quickly. If you look at anything with private assets, they'd be very careful. I'm not saying they're bad. And the foundation has some great ones, by the way, but they're not marked, they're not valued subject to the same whims of the public markets. And so sometimes what you're looking at is make-believe. Not always, but sometimes. And so be very careful with private assets. They can be good. And the only thing they have really going for them that public markets don't is you don't have to look at what they're worth all the time. It's kind of a relief, frankly, at times to think about it. So the foundation's private assets have actually been very successful, but a lot of that is still partially because they're not being valued the way the public markets are. And then last one, I think I have one more question. Is this true? Capital market valuation trends over decades track US and global population growth. So this is the underpinning of a long-term investment strategies. I'm going to punt that question, Ron. I'm sorry. I'm not sure I don't have a good answer to that. It sounds right that markets grow alongside population growth. That's fair. But is it the underpinning of long-term investment? I would not say that. I would say that underpinning long-term investment strategies is diversification and focus on what you're paying. So if I can get back to my example before, if I can pay 7 times earnings, a PE of 7x, and I get a 6% dividend yield, that underpins my investment strategy. I don't need anything else to happen. I just have to collect the income and I'll be just fine. And so those are the other ways we think about these things. And again, back to diversification and frankly, back to having people and an investment committee that are more than happy to step in to the controversies of today and say, you know what, I can own company XYZ in the tech sector because it's going to be fine, even though everybody hates this company today because it's not going to have profits for 2 years. We have a lot of those examples in the portfolio right now. And those will be fine if we have people making good decisions, which I think we do. So I think that's all the questions, unless there are any others, or otherwise I'll pass it back to you, Nancy.
Great. Thank you, Mike. Well, we're right on time. We'll wrap things up, give people at least a couple minutes before their next meeting. We look forward to seeing all of you in 2023 and have a wonderful holiday season. Thanks.